Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 105. On today's episode, we're going to talk about the U.S. debt downgrade, and we're also going to discuss all the multitude of earnings that have come out in the last 10 days. We'll highlight some of these specifically, and I want to start showing you, teaching you what to look for in these earnings reports to help you make investment decisions when it comes to your personal portfolios. So not every earnings report is the same. Depending on the company, there's certain things that are more important than others. And so we'll look at those and we'll look at some of these and how you can kind of put things together to make investment choices for yourself. So with that being said, get your mind right and let's get to work. Well, welcome back to the show, everybody. Thanks again for joining me today. Let's talk about company earnings. So lots of companies been reporting. The market has just been kind of gyrating on these earnings over the past couple of weeks. And we've had a number of companies report. And, you know, we in the middle of all this, we had the U.S.'s debt downgraded. So the rating agency Fitch, who is one of the kind of most popular rating agencies, took the United States debt from AAA to AA+. And so that caused some havoc in the market. It's the first time since 2011 that this has happened. And they cited kind of the debt increases that we have here. And you know, when your credit gets downgraded, basically they're basically saying you're not as good of a risk anymore. And so if you want to borrow money, that you're going to have to pay more, right? So think about yourself and think about your credit rating, which would be your credit score, right? So if you have a lower credit score, that means when you go to borrow money to buy a house or a car or whatever it may be, you're going to have to pay more. Well, it's the same thing for governments, especially if you're a developing country. It makes it to where it's more expensive for you to borrow money. So when you have a downgrade like this, you have the credit rating downgrade, then all of a sudden you see the 10-year interest rate, the 2-year, they start to move up. And so meaning that the U.S. is going to have to pay more money for somebody to borrow, for them to borrow money. So them borrowing money would be like the treasury bills that we just mentioned. So then now they're going to have to pay you more in order to do that. And so when you have those treasury notes go up, well, that's more competition for stocks. And so then you have the stock market drop. We had kind of a wonky week here. And so you have this, and then you have the earnings of companies coming out. And so it's just this massive amount of data that's coming out that everybody's trying to trade on. And so if you're a day trader, it's going to be pretty tough on you. If you're a long-term investor, then it's not going to be so much. So you have this happen, and then all of a sudden you have Jamie Dimon, who's the CEO of JP Morgan, come out and says, "Hey, you know, thought the downgrade was a little bit ridiculous." And then you have Warren Buffett come out and he says, "Hey, I'm buying $10 billion of treasury bills every week. I'm probably going to continue to do that with my cash," is what Buffett says. And so then you have these kind of people come out and calm the markets or whatnot. But, you know, last time we took it a lot worse. The market took it a lot worse when the U.S. got their debt downgraded. And so one of the misnomers, I think, is that we all assume that the United States has all this debt, right? And we do. And I think we've talked about it on a previous episode, but there's this kind of misconception that the U.S. is going to pay down their debt. Well, even after World War II, we didn't necessarily pay down our debt. We just grew the economy so much that all of a sudden the amount of money that we were bringing in, taxes and whatnot, was far greater than what our debt load was. So, you know, governments are thinking in terms of hundreds of years. And, you know, us as individuals, we think about, well, man, I only got 30 years or whatever it is. And so it's just kind of not the case. It's not the same thing, but it feels like it is. And it's something that a lot of people want to talk about, and it makes headlines. And, people use it for political reasons and all of that kind of stuff. So, it's something that's definitely worth taking into consideration, but it's not something to just make a decision based on that. So you look, and I have some highlights here. I want to go over some of the earnings calls that happened this week, some that are important, but I also want to talk to you about how I look at these. And so there's no, hard and fast, hey, these are the numbers you're looking for. This is what you want to see on an investment. This is when you make an investment, right? It's all of these things together, right? Call it the mosaic theory, where you're taking bits and pieces of information and you lump them together and you think about, would this be a good investment? It could be, obviously, it's the numbers of the company, right? What do their financials look like? But there's also some of these intangible things. What is the behavioral piece, if you will? What do people think about the company? What are the people inside the company? Are they owners? Did they start the company? Are they founders? There's just all of this stuff that goes into it. And so when you see, some people that are very much financially or accounting based, they'll look at these companies and they'll say, man, this is going to be a good investment. They can't understand why it doesn't work out. And sometimes it's because of the behavioral piece, maybe that throws it off. And so one of the ones I want to talk to you that I want to highlight first is Uber, right? Uber, the ride sharing platform, came out years ago. The company has not done well. Stock-wise, the company has not performed well stock-wise since it came out, since it came public, I guess I should say, use the correct terminology here. So when Uber became public in 2019, they came out around $41.50 a share, and currently they're at $45. They've hit a high recently of $50, and then their peak was in April 12th of 2021 at $60 a share. So, I want to talk about Uber's earnings, but a little caveat here. There's a lot of historical or a lot of academic data that shows when a company IPOs, right? So that's initial public offering. When they come to the market right from the get-go, most IPOs underperform the market in their first couple of years. And when you think about the reason for this, is that you have investment banks that are bringing these companies public, and they have this huge marketing machine. They're drumming up all this interest. You got to be invested in this company. It's one of the greatest companies in the world. Everybody's been waiting for it. Everybody's, cannot wait for this company to go public. You should buy shares. You should buy shares. And they just flood everybody with just, you got to be in this stock, right? And so then the company IPOs, everybody's in the stock. Usually the stock shoots up, and then all of a sudden the circus leaves town and they got to go work on the next one, right? So their marketing department and everybody that they've been using to drum up this business of investors to invest in these companies, they leave. And they go on to the next one because that's their job, right? That's what they're supposed to do. And then you just have this kind of lull. Normally, you'll have this lull after that happens, and the stocks usually kind of trade down for a little bit, and then you got to have the numbers to kind of back you up. So one of the things about Uber is that they, have not been profitable. And so early in my career, I would not invest in companies until they were profitable. And I missed some really good companies early. Like I missed Tesla early. I missed Amazon early. I missed, and it's not that I didn't invest in these. I did. I made money. I could have made more money if I would have just looked at this pattern. And so for me, looking at that pattern, always trying to get better, always trying to see where holes are. I'm looking at Uber a couple months ago, and I'm like, man, this looks like Amazon. This looks like Tesla. Like this is kind of, and when I say it looks like them, it's what I mean by that is that those companies were unprofitable and they slowly started to get more. The losses were less and less and less and less and less, and then all of a sudden they came out of it, right? Because there's so much money that has to be spent on infrastructure and getting these things. And then they can scale it. And Uber is the same thing, like so costly to get drivers, to get the technology right, all this stuff. All this money has to go in from the very beginning. But then later on, you can scale it and the cost stays the same because you've already invested in the technology. You've already invested in this. So That being said, there was a Wall Street Journal article that came out April 7th, 2023 called "What Happened When Uber CEO Started Driving for Uber." And this is the one that, like, I mean, when I read this article, I was like, oh my gosh, like, I've got to be in. Like, this was the one thing that, like, looking at the numbers, seeing the company getting a little bit better. And then I see this article and I go, oh man, I got to be in this. I got to be in this company. And so this article was the CEO of Uber started driving for Uber with nobody knowing. He bought a different car. He signed up on his own. He got a notepad and started taking notes of the things that were difficult. Sign-ups difficult. It's difficult to go from changing from driving people to doing Uber Eats and delivering food. He didn't like the fact that you couldn't tell how far you were going to, where you were going. I mean, there's all these things. And so I'm looking at that. He goes back after doing this for a couple months, shares it with his, high-end people at Uber and says, I want y'all to start driving for Uber. So they start driving on the weekends, right? So they can see what it's like to be a driver for the company. And I'm looking at that, reading that, and I'm going, man, if you have this kind of corporate culture where the CEO, the C-suite are willing to get out there and do the front end work, man, that's just a different company. That is a different culture. That's a different type of leadership. It's not as common as you would expect it to be, but it is so powerful when you have leadership that does that. And so looking at the numbers, combining them with that kind of management, those kind of decisions, I thought, man, this is going to be like, they are so close. And so then you look at this quarter and they have their first operating profit of, let's see, what was it? Oh gosh, $326 million. They had revenue, which remember, revenue is sales. So revenue of $9.2 billion. They have 137 monthly active users that are using the platform every single month. That's 2.3 billion trips in 3 months, right? So 2.3 billion trips in a 3-month period of time. And, they got 6 million drivers and couriers. And I think the future just looks bright for them. And they think that they can be profitable every quarter from here on out. I was excited because I thought it would happen this summer, but even the quarter that they just had, that was April, May, June. So that doesn't even include July and August coming up for the rest of the summer months, which, there's people traveling and using Ubers more so, I think, during the summer than other times. And so that kind of, when you're looking at earnings calls and you're looking at, this is the kind of information you want. You want to be able to grab information from different places, put it together, and see if the story is something that you believe in, that you think is going to get better. And that's where investment decision making happens, right? So, just a nice one to see Uber put it all together and for their hard work to pay off. The next one was Amazon. Amazon had a great quarter. Wasn't really that expected. And so because of that, you saw the stock jump almost 10% off the news, but it was really their guidance. So when these companies report, and just so you know, like if you've never heard one before, the company tells you what their numbers were for the past 3 months. And normally after hours, you'll see the stock move based on that, up or down. But that doesn't tell the whole story. So they tell you what their numbers were for the previous 3 months. They'll also tell you maybe what their guidance was. But then normally after they release the numbers and you have all this activity after hours, about an hour later or so, they'll do an earnings call where the C-suite comes on, they start telling you about it, and they offer some context. So sometimes the initial move you see won't be the move that you see the next day because of what management says on the conference calls, good or bad. I mean, I've seen it happen a number of ways where the stock jumps on earnings, then the company gives terrible guidance and the stock falls, or I've seen the stock fall and then the company gives better guidance and then the stock moves back up. And you got to, realize that businesses are a fluid thing. They're not just doing, they're not based on 3-month periods of time. So maybe they have a big deal that didn't close in the 3 months, but it closed 3 days after the 3 months. And so, it's kind of always a moving target. So you look at Amazon, they sold $134 billion. So their revenue, $134 billion. Earnings per share were 65 cents versus analyst expectations of 35 cents. And then they also gave better guidance for the next quarter, which is $143 billion, which isn't even their Christmas quarter. And so Amazon doing very well. But again, it's the Amazon Web Services that really is just kind of coming into its own and is really a profit driver for that company. And so because of that, it looks good. You couple that with Apple down on earnings, iPhone revenue not where it needs to be. People aren't replacing their phones, or they're not kind of in a replacement cycle. They're having their new phone come out in September. So this quarter, normally you don't see them beating on iPhone sales this quarter. But the one thing that is like the bright star of Apple that I think many analysts are overlooking is the growth in their services business, right? So this is those who sign up for Arcade or Apple TV or just all the, buying extra space, all those things. The services business for Apple is growing very quickly, and that is very sticky, recurring revenue that no matter what iPhone model you have, you're going to pay for. And so Apple's cash is up to 166 billion. And so they're already doing a share buyback. They're already paying a dividend. And so I look at this, I think they hit a high of 197. They're now at 182. If that comes down a little bit, I'd be looking to pick up a couple more shares. It's just the profitability of Apple is just tremendous. So let's talk about a couple that maybe might not be as as talked about. One that I like to mention on here is Mercado Libre. They're the South American version of Amazon. They doubled their profitability. It's a much higher price stock. It's $1,296 a share. So not everybody obviously can get into that and invest in it, but it's a name you should look at. It's a name you should know. They're just doing a tremendous job. You never hear about them on CNBC or any of the Bloomberg, any of the financial companies, but they're so big in Argentina and Brazil, and now they're moving into Mexico, and they're such an important company for South America that they got to be on your radar. Their all-time high was $1,800 a share back in 2021, which is when everybody's all-time high was. But their profitability doubled. Their sales are growing. Just a tremendous, tremendous company. All right, so let's flip the switch. Let's talk about somebody not doing so well, and that is PayPal. So PayPal, many of you are probably familiar with that payments company. PayPal also owns Venmo. So maybe if you don't know the name PayPal, you know Venmo. And so, gosh, this company has just been struggling. And that continues again this quarter. Struggling their margins. So margin is how much do they, if you sell something for $1 and your cost is 80 cents, then you have a 20% margin, right? That's the money you make. What's the percentage of the money you make? Well, their margin keeps getting compressed, meaning that it's dropping and not as good. And the reason is they're starting to get beat up by Apple Pay and all these other fintech service companies. And quite frankly, I just think that, PayPal was this huge growth company in the early 2000s. That's where Elon Musk was there. Peter Thiel was there that started Palantir. And there's just I don't even know if there's any founders left at PayPal. And it just seems like the people working at PayPal, it's just another job, and when there's data out there that shows when a founder is involved, companies historically do better than companies that don't have a founder. And, PayPal's supposed to get a new CEO. They haven't said who it's going to be. There's just all these issues. There's just so many issues. And I look at that company and I like the product. I think that there's a lot of value there. I just think that they're a little bit lost on what their strategy is. And it's just not a place that I want to invest right now. So it's one that I always look at. I've invested in it in the past, but it just seems like a struggle. You look at them and then you compare them to a company that we haven't talked a lot about, which is Shopify, a company that maybe you don't know the name, but you know the product. So Shopify does, for most websites, when you put something into the cart, they're the cart, right? So they're allowing you to check out, and they provide the infrastructure for that, and they do a great job. Well, they just signed a deal with Roku, and they're going to start being able to, when you see something on TV or when you see something online, you want to buy it, you're going to be, Shopify is going to be the technology that allows you to do it. It's seamless. I mean, what could go wrong? People make great purchases at 11:30 at night when they're watching TV or scrolling the internet. That old buy now button. But the company has a great CEO. If you go look him up, you talk to him, he does a great job of taking care of his employees, but he is invested. I mean, he is invested in this business. He thinks long-term. He's making moves that are good for the company. And I think that, this is another one that needs to be one you're looking at. It was $152 a share back in 2021. And it dropped all the way down to $26.94. And now it's back to 57. It's had a great year. Like it has had a great year. Its high was 70. It's come down to 57. But another one that if you look out over the next couple of years, Shopify should do well. Netflix said that 34% of all TV is streaming now. So with Shopify partnering with Roku, adding this ability to TV sets, partnering that with their e-commerce, they're starting to help smaller companies actually distribute the products. So this quarter they moved 55 million pieces of merchandise. They had 1.7 billion in revenue, and they're another just kind of good company that looks to have a good future ahead of them. And so, maybe not be right for everybody. It's definitely on the riskier end, but it's another company that you should go look at the earnings, look how they've done, listen to this, the conference calls, the CEOs, and start kind of formulating. Just because you're looking at these companies doesn't mean you have to invest in them. It doesn't mean they're going to be the right type of company for you, but looking at different companies and how they compete makes you able to see why some of these companies are such good companies to invest in, right? And why there's so many that you should stay away from. So, I know this is kind of a more in-depth, I guess I'll call it financially nerdy episode of like actually looking at numbers of companies and looking at what they're doing. There's a couple ways that a company can be more profitable. They can either let people go or they can have their sales go up, right? Their revenue go up. Well, Amazon this quarter had both. They let people go and their sales were up. So they kind of got a double whammy there. So knowing how these companies are operating, how they're beating their numbers or not beating their numbers is important. What's the sentiment out there? Is this a product that's kind of coming up, or is it a product that's going out, right? It's completely different if you look at these companies versus like an AT&T, a Verizon. It seems like a lot of bad news. This lead pipe and all these things they're going to have to do to clean all that up. So, you can go read those stories as well, but, you got to put together just kind of what your philosophy is on what kind of companies you want to invest in and who you're going to be willing to stick with. And that's the biggest key. So I'm going to close with that. When you look at investors and the issues that they have and the main thing that they do is they trade too much. That's the number one mistake investors make, is they trade too often. So it's important for you to find companies that you're going to be willing to stick with. If they pull back, you're going to be willing to put a little bit more money in. But in order for you to do that, in order for you to have the conviction to put more money in when things aren't looking so good, is you got to know the company. You got to know the financials. You got to know that on paper, they're looking pretty good. Quarter after quarter, they're improving, getting better. And so that way you're not too concerned about what the stock price is. and that you know that eventually if you hold on and the company continues to do what it's doing, that the company continues on the path that they're on, that later on the stock price will reflect that. So I hope this is helpful for you. Never mistake activity for achievement, and I'll see you next time. Thanks, everybody.